Today, we will talk about the implied rate. The implied rate is the difference between the spot interest rate and the interest rate for the forward or futures delivery date. The implied interest rate gives investors a way to compare returns across investments and evaluate the risk and return characteristics of that particular security. An implied interest rate can be calculated for any type of security that also has an option or futures contract. For example, if the current US dollar deposit rate is 1% for spot and 1.5% in 1 year's time, the implied rate is the difference of 0.5%. Alternatively, if the spot price for a currency is 1.050 and the futures contract price is 1.1071, the difference of 5.71% is the implied interest rate. In both of these examples, the implied rate is positive, which indicates that the market expects future borrowing rates to be higher than they are now. If the spot price for a barrel of oil is $68 and a 1-year futures contract for a barrel of oil is $71, the implied interest rate is calculated by dividing the futures price of $71 by the spot price of $68. Since this is a 1-year contract, the ratio is simply raised to the power of 1. Subtract 1 from the ratio and find the implied interest rate of 4.41%. If a stock is currently trading at $30 and there is a 2-year forward contract trading at $39, the implied interest rate is calculated by dividing the forward price of $39 by the spot price of $30. Since this is a 2-year futures contract, raise the ratio to the power of 1/2. Subtract 1 from the answer to find the implied interest rate is 14.02%. If the spot rate for the euro is $1.2291 and the 1-year futures price for the euro is $1.2655, the implied interest rate is calculated by dividing the forward price over the spot price by raising that ratio to the power of 1. Subtracting 1 from the ratio of the forward price over the spot price results in an implied interest rate of 2.96%. Here are 3 key takeaways. 1. The implied rate is an interest rate equal to the difference between the spot rate and the forward or futures rate. 2. The implied rate gives investors a way to compare returns across investments. 3. An implied rate can be calculated for any type of security that also has an option or futures contract. Hope this would help. Thanks for watching.